Picture this. It's 3:27 a.m., you're fast asleep, and your crypto portfolio just crashed 40%. There was no warning, no breaking headlines, no market halt to stop the bleeding, just pure panic pouring across screens in real time. That doesn't happen in the stock market because stocks close. They take a breath, but in crypto, the market never sleeps, and neither do your losses. Tonight, we're breaking down why crypto crashes feel so incredibly wild, the psychology, the structure, the chaos, and how you can actually use that chaos to survive the next one. Let's start with what makes crypto, well, different. When stocks crash, you usually get a process. There's the initial panic, then maybe a trading halt. Circuit breakers kick in, and you have analysts debating on CNBC, but in crypto, it's instant. No one hits pause. No one waits for regulators to step in. Crypto trades 24/7. No weekends, no market hours, no mercy. It's built on two things: human emotion and automated algorithms, both running non-stop. That's why when fear spreads, whether it's through Twitter, Reddit, or just a rumor, it moves at the speed of the internet. Before you can even react, millions, sometimes billions of dollars are liquidated. As 99bitcoins.com explains, this complete lack of a circuit breaker makes every crash sharper, faster, and much harder to recover from. There's no buffer, just a straight free fall. Now, let's talk about leverage, the gasoline that turns every small dip into a massive explosion. In traditional markets, margin trading is heavily regulated. You need special licenses, significant collateral, and there are strict limits. But in the crypto world, anyone can access 50x or even 100x leverage with just a few taps on their phone. So, when prices drop even slightly, those highly leveraged positions start to get liquidated automatically by the exchange. That forced selling creates more downward pressure on the price, which in turn triggers even more liquidations. The spiral just feeds on itself. That's exactly why you see those shocking headlines like $5 billion in liquidations in 24 hours. It's not necessarily some grand manipulation, it's a brutal chain reaction that's built right into the system. And that's why crypto crashes feel so intensely emotional, because they are. It's fear, greed, and automation all colliding in real time. Every major crypto crash tells a story. A lesson learned the hard way back in 2014. Mt. Gox, which was the biggest Bitcoin exchange at the time, vanished overnight after losing over 800,000 BTC. Confidence was completely shattered. Bitcoin fell more than 70%. Then came 2018. The ICO boom, where everyone was launching a new coin, turned into the ICO bust. Projects with no real product or utility disappeared, and Bitcoin lost nearly 80% from its all-time high. Fast forward to 2020 to the spectacular collapse of Terra. $40 billion evaporated in a matter of days. That single crash created a domino effect that dragged down major players like Celsius, Voyager, and eventually, the giant exchange FTX. Each time, the market lost a staggering 70 to 80% of its value, and yet, somehow, it always rebuilt itself. This incredible cycle of destruction and rebirth is what makes crypto both terrifying and fascinating. Stocks usually crash from broad macroeconomic events. Crypto often crashes from within, but there's another layer to this chaos psychology. Crypto attracts a unique type of investor, fast-moving, highly risk-tolerant, and deeply emotional. We're talking about people checking prices every few minutes, constantly chasing that next explosive rally. When the hype inevitably fades, that same emotional energy flips instantly into fear. The very same investors who are shouting to the moon are now yelling at us all over. The result? Volatility, unlike anything the traditional stock market has ever seen. It's not just a system that's wild, it's us. And let's be honest, crypto is still the Wild West. Regulation is vague and varies by country. Liquidity can vanish in an instant, and scams still lurk in the shadows, waiting for an opportunity. When a project or an exchange collapses, there's often no one to call. There's no government bailout on the horizon, no fake insurance to make you whole. The very freedom that makes crypto so revolutionary also makes it incredibly ruthless. So how do you possibly survive in a market that never sleeps? Step 1. Know the risk before you ever invest a single dollar. If you're actively trading, use smaller positions and always have stop losses in place. Don't be a hero. Step 2. Secure your holdings. Keep your long-term coins in cold storage, like a hardware wallet, completely offline and away from the risks of exchanges. And step 3, the most important one, detach emotionally. Crashes aren't endings, they're resets. This market brutally punishes panic and generously rewards patience. Crypto will always be wild, but that chaos doesn't have to mean loss for you. The difference between panic and profit is simply understanding why the market moves the way it does. So if you want to stay informed, prepared, and ahead of the next crash, do yourself a favor and hit that subscribe button right now, because in a market that never sleeps, knowledge isn't just power, it's survival. Thanks for watching.